Hey, what's going on, everybody? Welcome back to another video. In this one, we're going to be talking about how to find options to trade. This is kind of an option beginner video. You know, if you've been doing this a while, you already know this stuff. Some of these are basics. Some of these, this is stuff that you may know, you may not know. So hopefully you find something interesting in here. I was going to start this video with a bunch of this stuff like options values and intrinsic value and extrinsic value. I'm not going to do that. If you feel like that would be helpful, if you'd like to see a video on that, please leave a comment below. I would really appreciate that, and then I'll make a video on it. But otherwise, I'm just going to start here. Let's get right into the meat of it. How do you actually, what do you look for when you're actually looking for options to trade? That's what we're talking about today. Well, you could go to Wall Street Bets. There's some good due diligence there, and there's some bad due diligence there. I was mostly just very proud of this graphic that I put together many years ago. Okay, number one, first thing that we need to look for. Why am I holding this? Okay, is that better? Check. Okay. So, number one, the first thing that we're going to be looking for is liquidity. Now, in another video, which I will link in the description below, I talk about the bid-ask spread. That is super important to understand and to know when you're looking at options to trade, or if you're looking at a particular expiration or a particular strike. You want to see what the liquidity of that position is. That's going to change after hours and in the days and months potentially leading up to the expiration date, that bid-ask spread could change. But what we're looking for is a tight bid-ask spread. We don't want something that is very far apart there. And in that video that is linked below, I go into details about how the value is determined between the bid and the ask. But really, like, you don't want to buy it at the ask price, and then if you want to get out of that trade, having to sell it at a much lower price. It looks like there might be like easy gains there, but you could lose a lot of money by doing that. So basically, when we're trading options, the first thing that we want to look for is high liquidity. The other thing that we're going to look for, and this is kind of like one flows into the other, is we're looking for large cap stocks. So large capitalization stocks, high volume large cap stocks. Any large cap stock is going to be high volume. If you look at the options, there's going to be high volume on the options. Why didn't I put this into slideshow mode? Who knows? Okay, so let me give you an example of that. And let me show you like where I start. So first you can go to finviz.com, and what that's going to do is it allows you, this is a stock screener. You can, or that's part of what this does. Like you've seen these graphs around, right? So just go to screener and we can filter all of these. So these are stocks. We can filter this by capitalization. So I'm going to go up to market cap, and then I'm just going to go to mega. So this is what I would recommend if you're just starting out, especially look at large cap or mega cap stocks. And there aren't that many in mega cap. That's $200 billion valuation or more. Let's just pick one of these. Let's go Oracle, ORCL. Okay, so I'm going to pull trading view and ORCL. Let's take a look at this one. So I'm just pulling this up to look at the chart here. Let me look at, I want to look at like the daily, looking out by day. Okay. And then here, I'm going to pull this up on my phone that I'll put on the screen too. I'm going to look at the option chain on Robinhood. Okay. So let's go ORCL, and let's go trade options, and let's go out. Let's see, it's November 7th. So let's look out It's about 3 weeks out, November 24th. Okay, and I think, let's say I think this is going to continue. Let's see, we had a down day today, but let's see, gonna continue to rally to the end of the year. Let's say that's what I think. So I'm gonna look at a strike that is, typically if I am looking at strikes, I'm most of the time, if I am speculating that the price is going to move in that direction, I'm looking at out the money strikes, which means that my for a call, that the current share price is below the strike. So 109, 110, those are out the money. I'm in the money on the ones below this, and then for puts, it's going to be the opposite of that. So, and again, I would cover all that in a beginner video. I'm assuming you guys know that, but if not, please tell me to do that. Okay, so to break even, we can see it has to go up 218. So say I want to get into this trade right here. I'm going to click on this and take a look right here now. So the bid is 212 and the ask is 221. Now, we're after hours here. And I guarantee that when this is actually trading, the bid and the ask are much, much closer. But that's what you're looking for, is for that, you want that bid and the ask to only be like a couple ticks apart, which during trading hours, it's going to be much, much closer, probably within 2 ticks or 2 cents. As a side note, if you're wondering, the options move in cents, typically, most of the time. Options move in cents until you get up to $3, and then they go up to 5 cent increments. You might see that and be like, why are some in 5 cents and why are some in cents? That's why. Okay, so here's an example of something like I want to look at the liquidity. I'm looking at the liquidity of this. I see there's the volume is 110, which means 110 contracts were sold today, which isn't crazy big. Kind of a slower day. Let's see what this one looks like. 507, so that's much more. There's a lot more volume there. Again, just to hype that video that I did before on bid-ask spread, it's important to know know what that is, and know, like, when you're looking at those, I want those to be close, because as they're moving up and down, if I buy it, I want to be able to sell it and sell it for as high of a price or as close as a price to profit. You don't want to buy it way up here and then it's moving up and then you're trying to sell it, but the bid is way lower. So you get what I'm trying to say, right? Yes. Okay, so that brings up the question of what expiration do we want to look at? Now, this is a hot topic. You've probably seen it. If you're on the internet at all, you've seen stuff about 0 day to expiration options. And the thing that you have to be careful of there is that an option is made up of the value of an option is made up of a couple things. One of those things, this is part of the extrinsic value of an option, is the time value that is left in that option. So the time to expiration. The decay or the lessening of that time value is measured in what's called theta. And so you'll hear theta decay as describing this. And this is when we're looking at, I just Googled time decay options here. When we're looking at time to expiration, and then you're looking at how quickly this drops off here, what we can see is that over the course of 90 days to 30 days, these 60 days, you don't lose a ton of value, especially in these 30 days here. You don't really lose a ton of value. Same is true in the next 30 days. You don't lose a ton of value there. Over the next 30 days, you really start to lose a lot, and especially in these last, the last week, your value, the extrinsic value in your option is decaying very quickly. Now, it's important to note that that only really matters if the option is out the money. If it's in the money, it's the intrinsic value is what you're going off of, and there might be a little bit of time value left in there, and you can choose to sell that option if you think, hey, maybe the stock is going to stay about the same. Then the underlying stock price is going to stay about the same. Then you could go ahead and sell that get out of that trade, sell that option before it expires in the money, even if you are in the money. So what I'm trying to say there is, when you're choosing an expiration date for your options, stay away from these. These are where you want to be careful, because there's very little theta, there's very little time value left in that option, in the extrinsic value of that option. I typically, and this is not, do your own homework, do your own research, but if you're going to start, I like to go 3 weeks to 3 weeks plus out. Start around that, because you have a couple days in there where your time decay is in full effect. You are experiencing that every single day that you hold on to it. But you still have value in there, where if the price of the underlying, the actual stock, is moving against you, you have time to get out while you still have some extrinsic value left in that option. Okay, so we talk about that. So expiration date, I'd shoot around the 3 week, and do your own research on that. Spend time watching the option and the value of the option, and say, like, okay, how do the options that are 2 months out, how did those behave, and what are the price movements of those? You're going to find an area where you like the amount of volatility that occurs, and the price too, because as your options are further out, the expirations are further out, the more expensive they are, because there's more extrinsic value, there's more theta in that option. So anyway, I hope that made sense. If it didn't, say write in the comments that didn't make any sense, and then I will make a video talking about that, because it's important stuff. So let's see. So this is how you use this. FinViz is a great tool. Let's see what's next. So in order to actually determine what you think it's going to do, there's kind of 2 ways to go about this. One is, what are we looking for? One could be looking at charts. So you could say we're like, I don't know, let's just make something up here, but we're looking at Oracle, and I would recommend paying attention to one large stock. Look at it every single day, see what it does. Certain stocks do certain things, and you can develop strategies around those movements. Let's come up with a scenario here. Let's say that let's see, this is the 1 hour. Let's look at a minute chart. And I'm looking, let's look at today. Okay, so what happened today? So let's say that, I'm just making this up, this is off the top of my head, but so let's say, at around, so it's 8:50, let's say at around 8 to 9 p.m., and is this in my time? This is in, this is in mountain time. So you might say, between an hour and an hour and a half after open, we see a spike. When we see a spike in, and it could even be a certain amount of movement, you could say, I'm looking for at least 0.5% movement in the stock. So between this time, if I see a 0.5% movement, at least 0.5% movement, I'm going to bet the opposite way. I'm going to buy puts. So you could say, you could write right here, buy puts at, and put a time frame around it. At 8:45, you're going to make a play. So that's your strategy, right? You're looking at a specific time, and of course you'd want to look at a lot of days worth of data if you have access to data, to minute daily data, and you can program. You'd want to back test this for sure. And there's even some strategy testers that you can TradingView has one. I don't use it, but TradingView does have one. But so that's one way, right? Is that you are looking at the actual stock chart, and then you're developing a strategy around that. The other way to do it is not using this at all. It's going to be looking at the fundamentals of a stock and looking long term. You might say, let's see, Oracle. You might know something about Oracle's, their data providers for digital advertising, and you might know that there's I don't know if any of this, I'm just making this up, but you might know, or you might there might be word that they're trying to position themselves in a certain way and maybe make some acquisitions, and and that might look good for the future. So then you'd be looking at, I'm going to look out 3 months into next quarter, and I'm going to buy calls because I think that Oracle is going to make a nice jump in the next 3 months. Either look at charts and develop a strategy and back test that strategy, and you're looking at smaller time frames, or you're going to be you're developing an idea and a strategy around the long term, and that's going to be with the fundamentals of the business. You start with industries that it might be digital advertising. I know that industry well, and so I might make some sort of judgments based on that and where I think companies are going. Okay, and then I'm just going to briefly talk about this. How do you define your loss when you're trading options? Now, the purpose of this obviously is to define the max loss that we're willing to take within a trade, and you can do this in two different ways. One is position size. So as we know, and unless you don't, then please leave a comment and say, hey, I would like to know more information about this. If you are getting into an option position, each option contract is for 100 shares, and so say the option contract costs $2.24, so it's going to be times that. So as we know, also, if we're buying puts or we're buying calls, our max loss is defined as the premium that we paid. Now, of course, you could say, I want to get into 5 contracts, and then you'd buy, this times 5, whatever that is. And then you're saying, this is the max loss that I'm willing to take. So that's one way to do it. The other one is to set a stop loss. You could say, I don't want to lose more than 50% of this. So you could say, so if this is just one contract, you set this up and say, I want to set this stop loss at 50%, and so I'm willing to take a max loss of $112 on that trade. So that's another way to do it. And of course, you're most likely, well, not most likely, you are going to be combining these two, right? So you can use it in terms of like overall dollars lost. A lot of people do it as a position of their portfolio size. If you have $10,000, you could say, I'm willing to lose $10,000. I'm willing to lose 3% of this. So what would that be? 3% of 10,000 is going to be 3%. Man, that's ugly. It's going to be $300. And so then you'd figure out your math there. So you could say, okay, $300, that's going to be 2. I don't want to lose more than that. So that's going to be 2. That is going to be $2.24 if I'm in 2. So you could say, okay, I'm going to buy 2 contracts, and then I'm going to set my stop loss at 50%. That is going to be a max drawdown of $224 of my overall portfolio value of 1024. That's less, that's 2.24%. Or you could do it the other way and figure out exactly what 30% would be, and then be willing to adjust your stop loss, which would increase. So in order to get up to 3%, you do the math on that, but whatever, say it's 55%. I don't know what that would exactly be, but then that gives you a little bit more room to breathe there. And I will say that when you're trading options, your stop losses are going to need to be a little bit wider. If you can set them tight to begin with and see what happens, but it's really common to get stopped out with trading options. They're very, very volatile. That's why you can make a lot of money with them. Of course, that's why you can lose a lot of money with them. So it's important to always set a stop loss, understand exactly how much you're willing to lose on any given trade. And if you do lose that money, it's okay because you've already determined how much you're going to lose. Now, on the other side is going to be your win rate, or not your win rate, your win percentage. Where'd that come from? There you go. Is your profit, is how much are we willing to take and win? So you want to set a defined profit percentage so you can lock in those gains. That would be my recommendation to start. You hear a lot of people talk about letting your winners run. Well, that's true. You never know what's going to happen. And the number of times I've had an option play go up in value, go way up in value, and then quickly come down below what my profit target was, and me wishing, man, I wish I would have just taken my profit. So if you can define your profit percentage, and you can even set an order to sell once you hit this point, it helps you with growth projections, right? Because you can say, all right, my win rate is this, and my profit percentage is this. I can project that out. Of course, that's, that could not happen. Your win rate could go down, but it gives you a little bit more stability, and that's what we're looking for with options. We're looking for steady, long-term, stable strategy that works over the long term. We're not, I would encourage you. It's easy to get blinded by the big dollar signs, but we want to develop a steady, long-term strategy that works through market conditions and works over years, not just a week or a couple of days. That is all I got for you this time. I hope you enjoyed the video. If you did, please give it a thumbs up, give it a like, consider get a thumbs up and a like, same thing. Leave a comment if you want. I don't know, say something. And go ahead and subscribe to the channel. I'm trying to grow this, and I'll see you in the next one.